Why is an investment in Kinepolis a good investment? I will answer this motivator with the assistance of 4 questions. These 4 questions are the basic statements that every investor should ask before he decides to invest in a company. In my presentation, I'm going to answer every question separately, supported with numbers. First, I will talk about in which way the investment makes money. Secondly, I will clarify the basic financial information that the investment wants to know about the company. Next, I will look if the company is financially healthy. And finally, I will describe an advice and the specific risk associated with this investment. This first question, a financial wants to know if his investment is making money. With making money, I mean receiving a dividend, interest, or taking profit on the stocks you own. The payout ratio, or the percentage of the profit that is given as dividend, is 45% on the current profit of 45 million euros. In 2013, that results in a dividend of 3.90 euros per share, which is 10% higher than in 2012. When I look at the last 5 years, I see that the dividend is increased with almost 400%. For the future, Kinepolis expects to improve earnings per share further. The Kinepolis Group share has been listed since 1998 on Euronext Brussels. On the stock market, you have to predict which way the price will move. Will it be higher or lower than the current price? Do you have to sell, or is it better that you wait? The value of one share of Kinepolis is now 38 euros. On the graph from Euronext, I see that the stock price has a positive evolution from 28 euros to 38 euros in 1 year. The objective for 2015 is 40 euros. That's why most specialists are saying that it's better for the shareholders to keep their stocks now, because the share price is expected to increase. That's what you can see on the second graph. The second question is about some important financial information for an investor. With figures like profit or loss, and a vertical analysis of the balance sheet, the financier is beginning to know if the enterprise is profitable or not. Continuing now with the result of the company. As you can see in this graph, Kinepolis made less profit than last year. The cause is the decrease of the revenue from financial activities. This figure is reduced with 52%. You can clearly see the difference in this chart. The benefit of 2013 is 45 million euros, a significant decrease in compared with 2012, with a profit of 75 million euros. Furthermore, I would like to explain the profit appropriation using this pie graph. With the benefit of the year 2013 and the profit that is carried forward from the previous year, the society affects 39% for the general reserves. With the rest of the profit to assign, Kinepolis uses another 38% to carry into the next accounting year. The last 22% is for the shareholders' dividends. As last, an investor is also curious about the distribution of the assets, all liabilities and equity. Therefore, I made a vertical analysis of the balance sheet from Kinepolis Group for the years 2013 and 2012. Apparently in 2012, there are more fixed assets and less current assets than 2013. This is because of the accounts receivable that was increased in accounting year 2013. Concerning the liabilities and equity, the figures are almost the same in 2013 and 2012. But the disadvantage here is that 77% of the assets is financed with short-term and long-term debts. This is too much, especially when we see that the shareholders' equity is just 22% of the balance sheet's total amount. For the third question, is the company financially healthy? I'm going to look into the liquidity, solvency and profitability of Kinepolis. In a short financial analysis, I will compare the ratios of Kinepolis with the ones of a competitor, Palace Cinemas. First, the current ratio. This ratio is mainly used to give an idea of the company's ability to pay back its short-term liabilities, debts, with its short-term assets, for example, cash, inventory, or accounts receivable. The norm is that the ratio has to be higher or equal to 1. But the most important is that this figure is equal with the competitors in the same domain. As you can see, for the accounting year 2013, Kinepolis only has enough current assets to pay off 64% of its current liabilities. This shows this enterprise is highly leveraged and highly risky, but we see positive evolution for this ratio. It increased with 300% in the last 3 years. When we compare this with Palace Cinemas, I can conclude that the ratio is almost the same, except in 2011, where Palace Cinemas had a current ratio of 0.81 and Kinepolis was just able to pay off 21% of its short-term liabilities with its short-term assets. The quick ratio is similar to the current ratio, except that the quick ratio does not include inventory and the accruals. For example, some of the inventory isn't sold immediately, so these figures aren't relevant for paying off the short-term liabilities. As you can see, Kinepolis' quick ratio for 2013 is 0.67. This means that the corporation cannot pay off all of her current liabilities with the quick assets. Equally with the current ratio, we see a positive evolution during the last 3 years. Generally, the quick ratio of Palace Cinemas is higher than the one of Kinepolis Group. The solvency ratio indicates whether a company's cash flow is sufficient to meet its short-term and long-term liabilities. Concretely, this ratio expresses how many euro there is for 1 euro that represents the total of the balance sheet. It's ideal when the ratio is between 25 and 40%. The solvency ratio of 23.13% means that there are 77% more liabilities than there is equity. But each industry has different solvency ratio benchmarks, as some industries tend to use more debt financing than others. To examine that, I have compared this ratio with one of its competitors. I can determine that Kinepolis is in a better situation than Palace Cinemas. Their ratio is much lower, so the financial burdens for the competitor are higher. For the last 3 years, Kinepolis is using more debt financing, but their ratio is nearly ideal, between 25 and 40%. A profitability ratio is a way to measure a company's performance. Common profitability ratios are return on assets, return on equity, and the return on investment. I will take a look at the return on equity for Kinepolis. The ROE measures how much a company makes for each euro that investors put into it. As you can see, Kinepolis' ROE is 70%. This means that every euro of common shareholders' equity earned about 0.70 euro this year. It's important that the ratio is higher than the market rate. We're going to compare this with the interest of a short-term bond. This is best between 3 and 4%. The last 3 years this figure is fluctuating, but for 2012 and 2013 it was actually good. It's higher and better than the competitor Palace Cinemas. Because they had a loss in 2012, their ROE was under 0, and so it was very negative. To summarize, I can say that an investment in Kinepolis is a good investment. They have good expectations for the stock price, a high payout ratio for its dividends, an ideal solvency, and a high return on equity. Another advantage is that they are doing it pretty good compared with its competitors. The most important risks are the lower visitor figure, the profit that decreases, and a poor liquidity level. Thank you for listening.